Cable saw its best weekly performance in a year last week. So we had some key events on the calendar. So today we're going to be reviewing those and see what can we expect coming up. Hello and welcome back to our channel. My name is Daniela, and as I said, in today's video, it's going to be all about cable. We're going to be looking at the FX pair that is pound versus the US dollar. There were some key events on the calendar. We'll take a look at those. Also, what's to come this week. But before we get into it, please like this video, comment, and subscribe. So as I was saying, the pair cable has seen its best performance last week in a year. It was up 2.1% to end the week, the best performance since the beginning of November last year. Now, as I said, on the calendar, we did have some key events, which included the Federal Reserve meeting on Wednesday, the Bank of England meeting on Thursday, and the US jobs data on Friday. So let's quickly review all of those on the calendar, because prior to that, we had seen some increased demand for the US dollar. Of course, with the tensions in the Middle East escalating, we saw safe haven demand across the board. But given that the US dollar was already slightly overextended, the rally had been overbought, we saw a lot of that momentum actually going to gold. So the gains were limited for the US dollar because it had been rallying pretty much since the midsummer, when we saw that rapid rise in bond yields that was dragging the US dollar along with it. So we were at highs, and as I said, we were overextended. So that momentum coming from safe haven demand was slightly limited in the US dollar, but nonetheless, it was definitely keeping a floor beneath it. We didn't really see any interest in selling the US dollar in the last 2 or 3 weeks. Now, with these events that happened last week on Wednesday, we did see the Federal Reserve keep rates unchanged as expected. And even the commentary from Powell in the press conference and when he was answering the questions from reporters, again, everything pretty much as expected. He was talking about the fact that if rates are kept for a sufficient enough time at current levels, that it would be restrictive enough to bring down inflation to the long-term targets, that growth was still resilient, but we were starting to see some weakness in underlying data. And of course, that was all prior to the jobs data that we saw on Friday. So very, very basic from Powell, just kind of reiterating the fact that the central bank is still data dependent, that the economy is still showing good resilience, but the impact of previous rate hikes is not fully seen yet, and therefore it's expected that growth will slow further. Then on Thursday, we had the Bank of England, pretty much the same setup there, everything left unchanged, same commentary from Governor Bailey, but he did really put emphasis on the fact that he doesn't expect to see any cuts anytime soon. He pushed away the notion of quick cuts, even if the UK economy does start to show real signs of weakness and contraction. That gave markets a little bit of confidence in the pound. We saw a boost in cable on Thursday on the back of Bailey's comments and really staying firm with his objective to curb inflation. Now, as we know, the Bank of England has been quite resilient in the past to really be impactful and to be restrictive with its monetary policy, but it seemed to be enough for markets this time to convince them that he really is focusing on inflation. Inflation continues to be a concern in the UK. In September, it came in at 6.7%. Now, this month, in about 2 weeks' time, on November 15th, we will see the October print. And in Bailey's speech after the meeting, he did actually say that he forecast it to drop to just below 5%. I think somewhere around 4.8%. So it would be a very significant drop there, almost 2 whole percentage points for CPI in October. If that were the case, that would really, I think, justify the Bank of England's decision to keep rates unchanged, even though inflation remains at 6% at present. So I think that would definitely boost the pound if that were the case. There is still a way to go, as I said, 2 weeks for that. Prior to that, on the day before, we would actually see the US CPI as well, currently at 3.7%, expected to drop further as well. So there is some interesting data coming out. But in terms of this week, it is a quieter week on the calendar. We don't really have that much coming out. We'll have UK GDP on Friday. That is really the only thing that markets are probably keeping an eye out for. Quarter-on-quarter growth expected to have actually contracted to see minus 0.1% GDP in the third quarter. And also something to have on the calendar a bit further away again, but definitely something to watch out for pound traders will be the UK's autumn statement by Chancellor Jeremy Hunt. As we know, last year, a lot of the turmoil that we saw in the fourth quarter was because of the autumn budget that we saw last year. We saw that incredibly rapid spike in bond yields and that weighed on the pound heavily, hitting those lows against the US dollar. We can look at the chart in just a second, but definitely something to watch out for. I'm assuming there will be a lot of focus on that. Is Jeremy Hunt going to talk about cutting taxes? We know that a lot of corporations are demanding that. Growth in the UK economy has slowed a lot more than in the US, and inflation continues to be a lot more concern here than it is there. So, of course, that will likely weigh on the pair as well. Now, if we're looking at forecasts, the IMF has actually warned that the UK economy will see the slowest growth in the near term in the G7 countries. So again, the expectations for growth in the UK are quite dire, but I think markets pretty much focus right now on what the Bank of England's doing. And as I said, the fact that we saw Governor Bailey committing to push back rates cuts until it's actually really necessary. If we're looking at money markets, the first cut for the Fed is priced in for July and the Bank of England in September. So there is somewhat of a differential there that could be playing in favour of the pound as we go along. If we do continue to see this commentary from MPC members that they do want to keep restrictive until at least some of this inflation has really shown signs of subsiding. So that is pretty much it for cable. As I said, it's pretty much been a concoction of factors. The Fed, the Bank of England, and then, of course, the US jobs data coming in lower than expected on Friday. We did see the unemployment rate tick up slightly, but the NFP data actually coming in below expectations, and also average hourly earnings dropping from the previous month. So that coming in below expectations actually did weigh on the US dollar significantly, almost at a 2-month low. We saw it weigh on US yields as well, pushing back on the need for further tightening from the Federal Reserve. I think markets are now pretty certain that we will not see another hike from the Fed. And that, of course, has been seeing a lot of repricing in fixed income markets. US yields have been dropping for the last 5 or 6 days, the US dollar as well, which has allowed cable to really advance. So let's jump onto the chart now to see exactly what's happened. Okay, so here we have it, the pound against the US dollar, Capital.com via TradingView. As you can see here, quite easy to pinpoint the recent moves. So let's start off on Wednesday here. This was the Federal Reserve meeting. We did see some moves in the US dollar throughout, but pretty much ending the day flat on the open there. As you can see, a little bit of a bullish tilt or a bullish bias towards the end of the session. Now, on Thursday, we saw the Bank of England, as I said, a lot of those moves coming around the press conference as we saw Bailey pushing back on any quick cuts, even if the economy starts to show signs of weakness. So, of course, that propelling pound even higher, coming in just shy of the descending trend line here that has been limiting the highs since the month of October. It's a pretty short-term descending trend line here. So not really too much importance to it, but definitely an area to watch out for. As you can see on Friday's session, really breaking through it, seeing no hesitation here to push higher, breaking above the 50-day simple moving average as well. As you can see, just bang on that 123 mark. So again, that bullish momentum taking hold, that is mostly on the back of the weakness in the US dollar. If you want, we can quickly open the chart of the dollar index just to see. But we can see here on Friday, shedding around 1% throughout the day. Also, US yields really pulling back after that data showing a cooling US labor market, which is something that the Fed and markets have been looking for a while, and of course pushes back the need for any further rate hikes. But it's not only against the US dollar that the pound has been strong. We've also seen it here against the Japanese yen, also against the euro. You can see euro sterling here dropping on Friday and Thursday. So we are seeing some strength in the pound. I think after a while of continued sell-off, some sideways consolidation, struggling to find the momentum, it looks like traders are back and confident in the potential for the pound to push higher. There is a significant area of resistance up ahead I'm not sure you can see very well, but there is a yellow line here. That is the 200-day simple moving average. As we know, quite an important psychological level to watch out for. Currently at 124.34, just shy of where we are now. So we could see a little bit of indecision along that area. It doesn't necessarily mean we have to. The RSI is still pointing strong bullish buys in the short term. We're just off that overbought area, but we can push above it for a while. As you can see, back here in July, we were around 79.80 before we saw that reversal come in. So there is still a way to go for the RSI until sellers, I think, feel confident to try and trade the reversal. We've also got the Fibonacci level. Now, this is a longer-term Fibonacci. It comes from the sell-off that we saw last year from January to the lows in September. I was talking, this was the UK autumn budget around this time when we saw that significant drop in the pound coming to rest at around 103. Now, from this pullback, we did recover some good momentum throughout the last quarter of 2022. Kind of stagnated for the first quarter this year, seeing a little bit of a bullish bias in the second, heading into the third quarter. And now we're trying to recover some of that momentum. We have seen a lot of two-way trades around this 61.8 Fibonacci in the past, just around that 124.49 or 124.50 area. So I think in the short term, we continue to push higher. I think there is some strong demand here for the pound still. Of course, with US yields coming down and the US dollar, I think undoing some of that overextension that we've seen in the past 6 weeks, I think there is still further wiggle room here to move further. As I said, not much data on the calendar this week, so we will still be very, I think, sensitive to headlines, but also central bank speakers. There are a few coming up. And then, of course, on Friday, we'll see the GDP data. If we do see a stronger reading than expected, we could see this pattern continue even further, potentially heading up towards the 125 region in the next few days. That is it for today's analysis on cable. Thank you so much for watching, and don't forget to subscribe to our channel.